Hi, I'm Professor Suneel Maheshwari with the Eberly College of Business at IUP. Today we will be talking about the accounting for the dividends in the stockholders' equity section. How do you account for the dividends? How to compute the dividends both for the common stockholders and the preferred stockholders. When we account for the dividends, this is a return of shareholders' money back to them. Now, the dividends are taken out of the retained earnings, and retained earnings include your net income, less net losses, less any declared dividends, which is accumulated over the corporation's lifetime. So this is a cumulative number. The retained earning is a cumulative number, which is increases due to a positive income and decreases due to net losses, and when the money is returned to the shareholders. The next question, whether the company should declare and pay cash dividends. Usually it is based upon the earnings, and if the company has enough cash, they may declare the dividends. Some companies in the past have decided not to declare dividends. For a long time, Apple didn't declare dividends when Steve Jobs was there, and that is based upon the stockholders or the shareholders' preferences. Now, the dividend can take any of the three forms. It could take a form of cash. So the company can, if they have enough cash, they can just pay it in cash. Sometimes they may return the shareholders' money back in terms of additional stock that might be issued that has some market value, or in terms of non-cash assets. But most common is the cash followed by stock. If the company have enough retained earning to declare the dividends, then they have got enough cash to pay the dividends, the company can declare cash dividends. Once the board of directors declare the dividend, then the company is obligated to pay that dividend. Unless and until that dividend is declared, company is not obligated to pay any dividends. In terms of dividend, there are three relevant dates. That is, one is the declaration date, the date on which the dividend is declared. Date of record, that is whoever is the owner of the shares on that date. And then the payment date is the date on which the dividend is actually paid. So on June 19, the board of directors declare $50,000 cash dividends. In this case, it is debit to the retained earning for $50,000, and a liability is created, dividends payable $50,000. So the journal entry on June 19, that is the declaration date, becomes retained earnings debited for $50,000, and the dividend payable for $50,000. A liability is created, and that needs to be paid off. In terms of the accounting equations, assets is equal to liabilities plus shareholders' equity. Liabilities of dividends payable has increased, and the shareholders' equity has gone down by $50,000 in terms of retained earnings. On July 10th, the company paid the dividend declared. In that case, your dividend payable is debited. That liability is no longer there, and cash is credited as your cash has gone down. In terms of assets, your assets in terms of cash has gone down by $50,000, and the liability of $50,000 is paid off, so that is being subtracted. If you look at a T account for retained earning, there is a beginning balance. As we said, it will increase by the net income, and note that 1743 dividend is debited, and the net retained earning reduces by that. To get the ending balance, you add the numbers on the credit side, add the numbers on the debit side, subtract the smaller number from the bigger total, and the balance will be 20,038, which will be put at the bottom of the bigger number. So in this case, retained earning generally has a credit balance, and in this case it is showing an ending balance of 20,038, which will go to the balance sheet under the shareholders or stockholders equity. In terms of dividends for the preferred stock, you need to pay dividends on the preferred stock before you pay the dividends to the common stock holder. Generally speaking, for the preferred stockholders, dividends might be stated in terms of a percentage or in terms of a specific par value or a dollar amount per share. So it is either as a percentage of the par value or a certain dollar amount for the preferred dividends. If the preferred stocks happen to be cumulative, then the past dividend, if they were not paid, needs to be paid first. That is, any arrears, dividends and arrears need to be paid first. That is almost like a debt before any dividends can be paid to the common stockholders. So here is an example. Assume that preferred stock of Avant-Garde Inc. is cumulatives, and the preferred dividend of $150,000 in 2013 was not paid. So before paying the dividends to the common stock in 2014, Avanti must pay the $150,000 dividend for 2013 and 2014. So a total of $300,000 need to be paid to the preferred stockholders first, and then the remaining amount goes to the common stockholders. For example, on September 6th, a dividend of $500,000 was declared. Out of this, the preferred stockholders will get $300,000 and the common stockholders will get the remaining $200,000. Since the stocks were cumulative, the dividend for the past has been paid as well, first to the preferred stockholders. So the journal entry becomes retained earning debited $500,000, dividends payable preferred $300,000, and dividend payable common $200,000. To report the following in the stockholders equity section, you have got the preferred stock cumulative at $1 par, 6%, 90,000 shares issued. So in this case, it tells you that the dividend will be paid at 6% of the par value. There are 90,000 shares for a total of 90,000. Common stock in this case are 30 cents par, and 9,130,000 shares issued for a total of 1490. You need to compute the total amount of dividend, both preferred and common, for 2014 and 2015. If the total dividends are 900,000 in 2014 and 270,000 in 2015. So please note, if $900,000 is declared in 2014, first you'll pay to the preferred stockholders and then you'll pay to the common stockholders. In terms of 900,000 dividend for the 2014 year, you have got 6% dividend for the preferred stockholders, $1 par value, total shares are 90,000, so $4,500 is paid to the preferred stockholders. Since the dividends are in arrears, so for 2 years times 5,400, 10,800, and then your current year dividend of 5,400 needs to be paid. So the total that needs to be paid as to the preferred stockholders is 16,200. Once that is paid, the remaining goes to the common stockholders. Now, for 2015, your current year dividend for the preferred is 5,400, and the remaining goes to the common stockholders. Since there was all the areas for preferred were paid in 2014, there was no area. Now we can use these numbers to make the journal entries. When the stock dividends are there, you The stock dividends is declared in proportion to the shareholders' equity or the ownership, current ownership. So if you own 1% of the current shares, then when the stock dividend is given, you'll be given the right first to receive that 1% so that you maintain your ownership in the company. It increases the stock account and decreases the retained earning. The total shareholders' equity remains unchanged. Why would a company issue a stock dividend? Maybe to continue dividends but conserve cash, or to reduce the market price of the share. How does it reduce the market price? Because now more number of shares are outstanding in the market. So every person, suppose there was a 10% stock or 25% stock dividend is declared, then if you got 100 shares, you'll get 25 more shares of that stock. Now, size of the stock dividend does matter. If in terms of recording its value, if the stock dividend is 25% or less, then it is recorded at the market value. And if it is greater than 25%, it is recorded at the par value. The logic being that less than 25% probably would not impact the market price as much. So this is how you'll compute the preferred dividend and the common stock dividend. Thank you very much for your attention.